September 2015, Finance Minister Arun Jaitley first hinted that the government is inclined to privatize IDBI Bank. The share price rose from 55 rupees to nearly 100 rupees in a month on daily news that merchant bankers and private equity firms are doing due diligence to buy a stake in that bank. 3 months later, the Reserve Bank announced its asset quality review, which forced banks to recognize as NPAs loans to stressed companies that were being serviced only by giving more short-term loans or by evergreening. Bad loans of the entire banking sector shot up, more so for IDBI since, as an erstwhile development finance institution, IDBI had an overwhelming 40% exposure to infrastructure and related sectors like metals, mining and construction, where the stress is maximum. IDBI's gross bad loans shot up from 6.92% of total loans in September 2015 to 8.9% in December 2015 to 10.98% in March 2016 to a whopping 15.16% by December 2016. The government then changed the leadership, appointing Mahesh Kumar Jain, then MD of Indian Bank, to take over the headship of IDBI Bank. Mr. Jain is a career banker who has been an expert on risk management, first at Punjab National Bank and then Syndicate Bank, before taking over at Indian Bank in 2013 as Executive Director. He is also one of those rare public sector bankers with a management degree from FMS Delhi and a CFA degree from ICFI in Hyderabad. Jain's first quarterly results presentation of IDBI brought out more of the poison. The bank's gross NPAs have risen to 21.25% and net bad loans to 13.2%. So what's Mahesh Kumar Jain's strategy to pull out the bank from the bad loan mess? Here's his first ever media interview. Hello and welcome to Indianomics. In a dramatic move 2 months back, the government announced a new managing director for IDBI Bank, and the thrust seemed to be that they want to have a turnaround in the bank. Today, for the first time, the new managing director of IDBI Bank is speaking to the press, to CNBC TV 18. Mr. Mahesh Kumar Jain, thank you very much, Mr. Jain, for joining us. Well, that really is the first question that people want to know. You're coming at a time when the bank is in a very difficult situation. What is your turnaround strategy? What was the mandate that you got from the government?
First of all, I will touch upon the strength of the bank. The bank is having extraordinary brand value and the brand equity. It is having an institutional mindset. Yes. Large number of institutions have been created by IDBI Bank in the financial markets, which are of highest order today. The bank is having, by DFI status, bank is having extraordinary expertise and skills available in the credit. Apart from that, bank is having very high order of retail and franchisee, very strong retail and franchisee, which is equivalent to the new generation private banks. The bank is having very good clientele base, and the clientele base is to the order that if I analyze the per ticket CASA or per ticket retail exposure or per ticket SME exposure per account and per account other income, which is equivalent to the new generation private banks, very high than the public sector banks. Bank is known for its turnaround strategies by providing various advisory services through IDBI CAPS and others in the market to various people. So these are the strengths. Now in the areas which we are going to focus, we are focusing and we are identifying the areas with regard to the cost reduction, finding out the avenues to improve the revenues in a sustainable and profitable manner. We identified 6 areas. First of all, the bank should have a capital light business model. So in the capital light business model, our focus is that we have to grow our retail book and priority sector book substantially, whereas the corporate book, we need to shed or degrow the corporate book, or rather to churn the corporate book in such a way that we can save the capital from the corporate book either by shedding the high risk weighted assets or by increasing the margin or the pricing on those risk-based assets. So that's one strategy. Second is we are focusing from liability-led strategy to the asset-led strategy. So the focus will be more on the liability products. Presently, we are having quite high proportion of high-cost deposit and bulk deposit. Our cost of deposit is high, whereas our CASA growth is very good. Consistently, it was 20%, 22%. So our focus will be on improving the CASA, reducing the bulk deposit. During last one quarter Q4 and till date, we have shed around 35,000 crore of bulk deposit and high-cost deposit. So that will improve the fund management, resulting into reduction in the cost on the expenditure side. The third area which we have identified is improving our cross-selling. Because as I told that the clientele base is very good. 68% of the banking is on digital banking. 82% of the customers are having internet banking account. So presently we are having 1.5 product per customer. So we are going to do the analytics. We are going to cross-sell to our existing clients to improve the income as well as the product offerings.
Well, let me stop you there, sir. The more important targets which investors will want to know is on NPA. I mean, obviously you're coming at a time when the NPAs are above 20%, the gross NPAs. So the credit cost as well is very high. What is the goal on both these parameters for the current year?
On addressing the resolution of NPAs and credit, one thing what we have done, we have changed the organizational structure. We have created a dedicated vertical exclusively to deal with the NPAs as well as the flow of the NPAs. So credit monitoring and the NPA, which is headed by one of the best executive director of the bank. So that we have done it, supported by whole team to do the data analytics. The NPA, 78% of the NPL book of the bank is in the consortium. So when it is in the consortium, we cannot push the very hardcore recovery measures. We need to understand the industry, we need to understand the business, and we need to engage with the bankers to find out the resolution either by way of S4A or change of management or SDR and restructuring. That will give the scope for upgrading that account. So with that and slippages, we are focusing on credit monitoring, the data analytics, the SMS, the internet. Through that, we are going to start from SMA 0, SMA 1, SMA 2, RFA, early warning signals. So there will be a dedicated focus on preventing the slippages. With these two-way strategies, I am confident that in 17-18, the slippages will be lower than the 16-17. Credit cost also will be lower than the 16-17.
Now, you know, if you gave me a growth strategy and an NPA reduction strategy. Both these will require capital. Are you confident? Has the government given you the confidence that you will be given what you want?
I am confident that I will be getting the full support from the Government of India as a largest shareholder. Second, we have identified certain areas where we need to reduce our RWA, risk-weighted assets. That exercise we did it, and we reduced RWA from Q3 to Q4 to the extent of around 60,000 crore. So the same strategy we are going to adopt so that my denominator may reduce. Second, we have identified non-core assets, and we have a plan in place. We have formed a committee, and non-core assets we are going to downsell during this financial year at the right time and the right valuation. So these three areas I am confident that we will be able to get the capital augmentation to the extent required.
So the more immediate problem that you face is the rating downgrade by the rating agency. What is the immediate impact on the bank? Does it mean that your borrowings will become expensive?
The rating agencies are having basically two concerns, and that is the reason they have downgraded our rating, one on the asset quality side and second on the weak capital.
Yes.
As I explained earlier, on the asset quality side, we are taking a lot of initiatives by improving our underwriting standard, addressing the slippages, and we are taking dedicated efforts for recovery and resolution to the existing NPA. So that will help as far as asset quality is concerned. Capital, as I told, that there will be efforts from the bank side to augment the capital, and there may be a support from the government side also to augment the capital. So these aspects will basically reduce the fear of the rating agencies in next 12 to 18 months' time.
So are you hoping that you will be upgraded back by the rating agencies in a year or 18 months?
I expect and I hope that we should be looked into by the rating agencies in that perspective, but probably they will start their action once they are able to see the results. So first we have to show the results to them, and then I can expect and demand a rating action.
Okay, the other part I wanted to ask you, and you alluded to it, non-core assets. What is the plan in terms of disposal of non-core assets? Any timetable you can give us?
That is what I told earlier, that we have identified the non-core assets, and we have formed a committee also headed by DMD. We are in constant touch with our various subsidiaries as well as the market players who are keen to come and invest in those core assets, non-core assets. So we have already started. The real estate also we have identified where it is a surplus space available with us, how we can best use it. If we are not able to use it, we will sell it in the market to mobilize money and to augment the capital. So we are on track.
Well, some numbers, Mr. Jain, on what kind of deposit growth you are planning, what is the low-cost deposit growth that you are planning, and advances as well. What are your numbers for the various subsectors?
We are targeting for this financial year CASA growth around 20%, retail term deposit around 8 to 10%, and bulk deposit and wholesale deposit a reduction. Overall growth, we are targeting to maintain the 75% CD ratio. That will reduce my cost of funds. On advances side, as I told earlier, that our focus will be on retail, realty sector, and there we are targeting around 15 to 18% growth. There may be degrowth because of a strategy in our corporate credit. There may be a little bit growth on our mid-corporate side. So end-to-end, the growth in this 17-18 on the advances will be maintained with the CD ratio of 75%.
I was hoping that you will give me some targets on NPAs as well, gross NPAs at 21%. So within this year, what is the expectation?
Present net NPA is 13.21%. We are targeting that net NPA should come down at least by another 2 to 3% minimum in this financial year. My internal target is around 10%. So let us hope that how I will be able to achieve.
By the way, you all are also, at above 10% net NPAs under prompt corrective action of the Reserve Bank. Does it mean constant conversation? Do you have to meet them regularly?
Yes. I am constantly in engagement with the regulator. I am in constantly engagement with the government also with regard to finding out various workable solutions and to find out that how we can work around. As far as resolution is concerned, NP resolution, in various accounts we are the leader. So we have identified wherever we are the leader, we have fastened our process in engaging with various bankers as well as the client. I have already done a lot of interaction with the various corporate clients, one-to-one. Wherever we are the member in the consortium, I am in discussion with my counterparts of the large banks to find out the solutions.
Mr. Jain, I have a few more questions for you on the banking sector's NPA resolution process. We are back in a minute after this short break with more questions for Mr. Mahesh Kumar Jain.